Hi, I'm Maciek Zaremba with Sarasota For Sale over at Keller Williams, and today we're going to talk about something very important: what happens when interest rates increase. Well, no one wants to hear it, but the truth is interest rates have been increasing. It's been about 2 years now that they've been on the rise, and the days of 3 and 4% are over for quite a while now, probably about a quarter at this point. We're expected to have interest rates go up probably to the healthy 6%, maybe 7% levels. But what does that mean for you as a buyer, and what does that mean for you as a seller? So first, we're going to talk about the affordability of interest rates increasing. So when interest rates increase just about a quarter point, maybe half a point or so, as a buyer, you can afford less because your payments go up slightly. And whenever you apply for a loan, they're looking at you from the housing expense ratio. That means the ratio between how much you earn per month, how much you spend on your housing. So that now goes down, meaning your interest rate increase causes your payments to be higher. So in terms of affordability, it doesn't change it that much if you only have a quarter of a point or half of a point, but it does affect it. So keep that in mind, that you can buy less house for the same payment. Now, the second thing is that the principal and the interest ratio changes. So if you are at a low interest rate, basically we know that the first payment you make on a 30-year fixed mortgage, the majority of your payment is going to be into the interest column, and just a little bit is going to be principal. If you have a very, very low interest rate, let's just say 1% for some reason, which we're never around, but if you had something like that, you're probably in a pretty healthy ratio. Well, as interest rates go up, that ratio gets less and less healthy, and you're having a very small principal pay down. So not only does your payment increase, also how much of it goes towards principal decreases. It's like a double whammy. Third of all, prices going down. Now, why would you relate prices to interest rates, and how much are they going to go down? Well, that all depends what happens, and every market is a little bit different. Here in the Sarasota, Bradenton, Siesta Key market, what happens is when our interest rates go up, there's a lag effect before the prices go down. And what I mean by that is interest rates might go up today, and people are shopping, and most people are going to be able to afford what they could afford or something very similar. Or some people might start shopping a little lower. Other people might shop a lot lower because they're afraid. And then what happens is after a while, less homes are selling. And there's some sellers out there that must sell. They have a job relocation. Maybe they need to downsize because all the kids have graduated college and left, and there's no need for them. They want to sell. And as less homes sell because the affordability goes down, there's more desperation and prices just naturally go down. That doesn't mean a 2008 crash, don't get me wrong. It just might be 5%, 7%, maybe a little bit more, maybe a little bit less. But basically, the prices go down. So as a seller, you may want to go and price ahead of the market, meaning you see interest rates going up, you're afraid that things are going to go down 5%, just lower your price 5%. Get it done, get it out there instead of chasing the market over and over. And now as a buyer, as prices go down, you like that. You want the prices to go down. So where is that curve? And where is that curve on top? That's the hardest part, and I don't have the crystal ball to predict, and neither do you. But do your best and buy when the payment is right for you and your family. Thanks a lot for watching this video. I'm Maciek Zaremba. You can reach me at Sarasota at sarasota.com by email, or you can call me 941-400-7084.